Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my European opening market comment for Friday, June 17th. Well, there are no major indicators out during the European morning. ECB board member Benoit Cœur will speak. He hasn't said much about policy recently, so it's hard to guess what he'll be saying. Later in the day, ECB President Draghi speaks. Now, he often takes a dovish stance, so the euro could weaken a bit when he's talking. With no indicators out this morning, instead of talking about the indicators, this morning I'm going to discuss an article I wrote for the NASDAQ website yesterday. Now, what emerged from two of this week's four central bank meetings was the conclusion that real interest rates minus the rate of inflation, would stay lower for longer than expected. In the U.S., the FOMC lowered its forecast for end 2018 interest rates by around 50 basis points. Yet, they left their forecast for inflation unchanged for both 2017 and 2018. That means lower real interest rates. The Swiss National Bank reached the same place, but from the other direction. It kept its rates the same while predicting a slightly higher inflation rate. Make that less deflation for this year, and a slightly higher inflation rate for 2017. That also means lower real rates. Now, what was particularly significant for the Fed was the change in their forecast for the longer run level of the Fed funds rate. Their median forecast fell 25 basis points in March and another 25 basis points this time as well. That's huge, considering that this is their forecast for the rate over the long term, over several economic cycles. It's particularly significant since there was no change in their forecast for the long-run rate of growth or inflation. They're now saying that for a given growth and inflation combination, interest rates will probably be lower than they were before. Their forecast of a long-run Fed funds rate of 3% is only a bit more than half the actual long-run average, which is 5.75%. The Fed's downgrade of this long-term rate coincides with an important break in the market's expectations for inflation. Until recently, the market's inflation expectations were closely correlated with the current price of oil. But in late April, the two started to diverge. Inflation expectations headed lower, even while oil prices headed higher. Perhaps the market thinks that higher oil prices are only temporary, as do I. Perhaps I see energy prices having less impact on inflation over time. Whichever, this change in inflation expectations is indeed worrisome for the Fed. Note that this is also the week that 10-year German Bund yields went negative, suggesting that in Europe, too, investors see little prospect of inflation anytime soon. And the five-year forward inflation forecast in Europe has reached a new record low, too. Now, we haven't quite reached that point in either the US or the UK. But the question I have is Japan's experience becoming a harbinger of things to come? There in Japan, overnight rates have been 50 basis points or less since 1995. Yet inflation has only exceeded 1% during the times when the government raised the consumption tax. It could be that we're going to see global conversion to the Japanese norm, at least among the advanced economies. Now, what would this mean for currencies? In the near term, it probably means a weaker dollar as the monetary policy divergence theme fades even further from view. It's bullish for emerging market currencies as the reduced likelihood of any Fed tightening improves the outlook for those economies. It improves the outlook for carry trades. Within the G10, that means the Kiwi and the Australian dollar, the currencies with the highest interest rates, might benefit. In emerging markets, it means the ruble, Turkish lira, and South African rand are attractive because they have the highest rates. Now, I'd recommend caution with carry trades right now and also with emerging market currencies in general. That's because these trades don't perform well when there's a risk-off environment. And next Thursday is the Brexit vote, which could turn out to be a serious risk-off event. For an update on the U.S. indicators coming out today, please watch my North American opening market comment later today. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.